Welcome to Money Matters TV. My name is James Chan. I'm your host in this episode, and I'd like to introduce my co-host, David Emery of Marshall Financial Group. Hi, David.
Hi, James, and welcome. I'm glad to be working with you here today. So before I start, I just need to read our compliance memo. So again, my name's Dave Emery. I'm the Certified Financial Planner with the Marshall Financial Group. And the Marshall Financial Group is an SEC registered investment advisor with its principal place of business in Doylestown, Pennsylvania. For additional information about Marshall, please request our disclosure brochure as set forth on Form ADV using the website www.marshallfinancial.com or refer to the Investment Advisor Public Disclosure website, which is at www.advisorinfo.sec.gov. Any information on today's show is not intended for personal advice. All right, James, welcome. I'm glad to be working with you again today.
Yeah, same here. What a day. Well, it's better to do this than to have to trek all the way to the studio.
That's right. So this is my first remote show, and I think it's come out. So far, technology is a wonderful thing.
I agree with you. Well, what would you like to talk about today? How about something like financial income planning? It's something that you certainly are qualified to talk about.
Well, thank you for that. One of the big areas, I guess, recently, I wanted to mention is, with this CARES Act, with the big stimulus package that the president has put into law, and that really has impacted retirement income planning in a couple of ways. First of all, you have to, before you could access something like that, you have to have been affected by the coronavirus or have a family member that's been diagnosed with the coronavirus. And then on top of it, some of the other conditions are, or you are financially impacted from it, such as being furloughed, going on unemployment, loss of a job, loss of child care due to corona, so it impacts you. But so you have to be materially impacted financially from the coronavirus. And once should you be that, then you have some retirement benefits that you can access.
So, Dave, are you saying that it's not automatic? You have to apply, or you may have to ask somebody like you and other people to fill in the right forms in order to get whatever benefits or subsidy, whatever you want to call it. Am I correct? It's not automatic.
I'd say it's more along the lines of kind of knowing what the legislation has in it. There's just a couple of areas we can chat about briefly.
Right.
Retirement plans.
Mm-hmm.
If you qualify based on those, being impacted by the coronavirus,
right,
you can take money out of your retirement accounts, like your IRA or 401k, without having a 10% penalty. It's normally, if it's before age 59 and a half, you would have a 10% tax penalty.
Mm-hmm.
And you can access up to $100,000 or 100% of the balance of your account, whichever is less. And and by doing that, you have 3 years to pay it back. So it's basically you can access it tax free in essence if you do it, by the rules. And over 3 years, you have 3 years to pay it back. So that's one big change. And then the other area is by taking a loan out. First of all, the government has allowed for 2020 to not have the clock started taking a loan out from your retirement account until after that. So you have 5 years after that to start paying it back. So those are two big changes with regards to retirement accounts for people that have been impacted by this virus.
Is it true, Dave, that people don't have to take their minimum requirement, the distribution thing, if they can delay? Is it true?
Mm-hmm. That's absolutely correct. That's another provision of it that for 2020, the requirement to take your required minimum distribution has been, furloughed, or you don't have to take it out. Of course, if you need the money, you can still take it out.
Sure.
The government has said that you don't have to take it out for 2020.
But how long is the delay, or is there a policy, or they're still working at it?
It's just for 2020. So
okay.
Just for 2020, you don't have to take your required minimum distribution.
Mm-hmm. what do you think people need to be aware of in addition to just money matters, so to speak, like the sociological, social aspects,
Mhm.
psychological aspects
Yeah.
of retirement? Can you talk about that, Dave?
Yeah, absolutely. So yeah, there's a number of areas outside of just the financial aspects that people sometimes don't always think through regarding retirement. What I mean by that is, people work. You work. Your work life takes up a lot of your week. So
Mhm.
part of your work, you get a number of things from it. Of course, you get a paycheck. You have an identity with it. You get a sense of value and accomplishment. You have social, people, you have friends at work. So all those different areas, when you retire, that big aspect changes. So, it's understanding, what are you going to retire to? And within that, how are you going to, basically, um, fulfill some of those areas that work had already fulfilled for you. So
Yeah,
it's
I'm sure.
important to
Yeah,
kind of think through that before you retire.
very good. I'm sure we can continue on this because it's such a broad subject. In the meantime, why don't we take a question from the viewers for you, Dave? And
Okay.
the question is from Ken Wells of Philadelphia, and it is, how can you reduce the financial cost of divorce? Right down your alley.
That's right. Well, that's another avenue where I help many clients. I help them, work through the financial aspect of getting divorced. And the one thing I will say is, I guess the short answer is, if try to have a working relationship with your ex-spouse. And what I mean by that is, the more that you can kind of come to an agreement on the the division of marital assets, and even marital property, and what's custody issues and things like that, outside of having lawyers in the room, is a big area where you can reduce the cost of divorce. I mean, I guess in short, it's find avenues that you can find common ground and not have to go to court to fight about it. Because once you go to court and fight about it, the cost can go up significantly. So that's the big area. I know it's easy. It's often easier said than done, but if you can kind of try to accomplish that, it makes a lot of sense.
Very good. Let's give an opportunity for our viewers to ask other questions. This is how you send in your questions to Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Welcome to Money Matters again. In this episode, we have a wonderful guest. Our guest is Tami Fratis. She is Managing Director of Phoenician Ventures. Hi, Tami. How are you?
Good. How are you, James?
Doing fine in this sunny day. So tell your viewers, tell our viewers about yourself, your Phoenician Ventures, and I know that you are a specialist in private equity and private equity investing. Maybe the majority of viewers would be curious as to your definition of private equity investing, and finally, what is the difference between private equity investing as opposed to investing in the stock market?
Sure, James. I'd love to do that. So for our viewers, anyone could call their broker or financial advisor and decide to invest in the stock market. The stock market is liquid, and you can invest in big blue chip stocks, or you can invest in the NASDAQ and smaller tech stocks. And it's available to anyone that has the capital to invest. You can buy 10 shares of stock. You could buy 100,000 shares of stock, depending on your income.
Right.
Private equity is a little different because in order to invest in private companies that do not have publicly listed stock on any of the exchanges, you either have to invest through a fund or you have to invest directly as an angel investor. And in order to invest directly as an angel investor, you have to make a certain amount of money every year, or you have to have a certain amount of net worth to invest. And your financial advisor can help you meet those criteria or try to meet those criteria. And you can also invest in platforms like crowdfunding. So the difference I would say is if you're a person, let's say you have an opportunity through an investment group to invest in a private company, whether it's a local private company or a pipeline public company like the Cabbage Patch dolls at one point were really hot, you can put your money into this company as a private investor versus buying stock in the stock market like IBM or oil stocks or any kind of stock. So that's really the difference.
So Tami, how has the coronavirus impacted the private equity industry?
Sure. So the coronavirus, as you know, has impacted the public market. A lot of volatility, a lot of stocks lost a lot of value. They're gaining value back though. In the private market, the private market is typically not as volatile when we have economic downturns. However, the coronavirus, because it's really impacted all walks of life and all industries, the private equity industry is impacted because a lot of the portfolio companies, a lot of the companies that the fund managers like myself have invested in, can't reach their clients, can't sell their products. The restaurants aren't open. They can't get their supplies from China. Their workers don't show up at work. So it's impacted a lot of private companies, just like it's impacted the public companies. But the real difference is, as a private investor, you don't actually see the volatility. So you're not aware that your stock is losing, $50 a day or 10% a month. You only get your reports quarterly, so there's not as much information about how much the companies are impacted. And the same way, the earnings aren't impacted as greatly because you're looking at a longer term perspective with the private companies. You should be looking at a longer term perspective in the stock market as well, but a lot of times investors, because they have the information so much earlier, they get more anxious and they want to sell when things aren't good. You can't really do that with private companies. You have to go for the longer term because there's no liquidity.
Right. Tami, question from me. I'm sure that there are reasons why people want to invest, high net worth individuals want to invest in private companies. Can you kind of give examples of the major reasons why people want to do that versus putting their money in the stock market?
Sure. So one reason is what I just mentioned, that the stock market generally is more volatile and also is more prone to group thinking. So a lot of times companies get impacted negatively just because one bad thing happened and then all the large traders sell the stock. And so the company's hurt dramatically by one bad thing happening when the company's still a really good company. Conversely, a private company could have negative things happen to it also, but because people don't have the liquidity to just quickly dump their holdings, there's less volatility. So that's one reason. The other reason, too, is when you invest in private companies, you usually are investing in the leadership team. And the leadership team usually has more ownership in the company. So your goals and the leadership of the company's goals are more aligned. Everyone wants the company to grow because if this is your whole net worth, meaning the CEO's whole net worth is tied up in their own company, they're going to do what is best for shareholders because they're going to do what is best for themselves. So a lot of Go ahead.
I'm sorry. Sounds like it's a little bit of the franchise situation. Of course, that analogy is just too broad. In
right.
words, you have a share. You have ownership in a way.
Yes, you do have ownership, even though you don't have a lot of voting rights, but you do have ownership, and you do get to uh, purchase products and services sometimes from the company you own. You also do get to see sometimes, depending on what you're investing in, your company, what they're doing. So, for example, if you were an investor that invested in Beyond Meat as a private company, and this is a vegan product, and you suddenly see Beyond Meat in Burger King or Beyond Meat in the supermarkets, you know that your company is out there. And even if in this case, Burger King maybe has less revenue because people can't go as readily to Burger King, you still know that your products are being eaten and distributed and sold nationally. And it's, you can see that real time.
So why would people want to sell their companies, I guess, at this time? And I guess another question I had around that too is quarterly statements, when they come out, you said that that's when the investments get valued. How do they value those investments?
Sure. So in the venture capital and private equity industry, you have to value your investment at the cost of what it costs you to invest in the company, unless there's an outside third-party valuation, or unless there's other investors that have invested in the company. So let's say you invested $100 in a private company, and the valuation of the company was $1 million at the time. If no other outside transactions have happened, the company's still valued at $1 million valuation. If another private investor came in and put another $1 million into the company, and now the company's valued at $2 million, now you get to take a step up in what the company's worth, and you could say your value is now $200, but you don't have liquidity. Conversely, if you invested $1,000 in a company worth $10 million, and because of the coronavirus, your company took money in because they were desperate for cash, and the valuation is now half as much, $5 million, you know that your stock that you own is now worth half of what you paid. But again, since you can't sell it, you're not going to take a loss. You're just going to have to hold the value and hope that things improve in the future. Right. So it's a much different investment strategy, and it's not for everyone.
So
your second question as to why people would sell their company now, the strategy. So Phoenician Ventures helps venture funds, private equity funds, and portfolio companies increase the value for their shareholders. That's what Phoenician Ventures does. And today, Gaston Capital is the firm that I'm helping increase their shareholder values. And Gaston's strategy is to buy baby boomers companies that would like to retire or like to take liquidity off of the table because they're getting older, or they want to de-risk everything being tied up in their company, and bring in private capital, which is what Gaston Capital is, so that they can gradually exit their companies because either they want to retire or they're tired of working for 40 years and suddenly their doors are shut or their workers aren't showing up because of coronavirus, and they just want to de-risk. They want to bring in a partner.
Can investors in private equity companies kind of pass their investment to their sons and daughters? Is it difficult?
No, actually, almost all private companies in their documentation, when they bring in shareholders, have in their shareholder documentation that they're allowed to transfer their ownership for estate planning purposes. And in fact, a lot of older investors do just that, because the companies they think have value, but the value isn't liquidated yet, isn't realized yet. So they say, rather than me try to sell my stock on a secondary market for a discount, which is also an option for liquidity, they just give it to their children or grandchildren in their estate planning process.
Very interesting. Dave, you have another question for Tami?
Yeah, so I guess this might be, you may have answered this already, but so why would family offices want to invest in private equities versus the stock market? Anything more you can say about that?
Sure. So on the family office side, as you know, David, you want to have diversification. So the stock market is one piece of your portfolio, and the real estate market is another piece of your portfolio. Alternative investments, which is what private equity is another piece of your portfolio, another diversification tactic. Why it's really interesting now for family offices, some family offices want to invest in private equity, especially buyouts, is because we have all-time low interest rates. And we have, as private equity investors, the ability to buy companies at good valuations and to get leverage, to get debt at very low interest rates. So the cost of capital for those companies that we're investing in is so low. As long as we have a plan as private equity buyers to grow the companies and not over-lever them like was done back in the heyday of the big LBOs.
So, and access to capital is still, still not an issue then, I guess.
Access to capital for good companies is always available. And in the really low interest rate environment that we have, even if you go to the mezz debt lenders, which tend to be higher interest rate lenders, everything is relative. Instead of a 3% interest in the banks, if you can't get bank capital, well, now you can get 8% interest in some of the higher risk debt lenders.
So is there like a time period? I mean, you say it's for, it's illiquid and also for a longer term investment. What does longer term mean? I'm sure it's
Sure.
very, very
Sure.
fluid.
Sure. So most funds are 10-year funds. So if you were to get into a fund day one, your total investment wouldn't be liquidated for 10 years. However, as investments mature, you get liquidity back. So typically Gaston Capital has returned more than 100% of the invested capital within a 5-year period, but you're still getting distributions from other companies as they mature and are sold also. So there's no guarantee that you won't get investments in the first 2 or 3 or 4 years of return of capital, but you know that within 10 years you're going to get money back, not necessarily 100%, could be more than 100%, could be less than 100%. But again, it's diversified amongst the portfolio of private companies.
Tami, are there enough data to show that it's more profitable investing in private companies this way? Do we have enough data to prove it or to show
Yes.
it?
So if you go to some of the statistics, every fund has a vintage year, just like a wine. And certain vintage year funds do better than other vintage year funds. It always depends on when you're investing. So if you start investing in periods where the stock market is very frothy, when interest rates are high, when access to capital is very easy, so there's a lot of competition for deals, those vintage year funds tend to not do that well. However, there's always exceptions. It's based on the track record of the fund managers. Other vintage years for funds, after the real estate market has had a downturn, after the stock market has had a big hit, when private companies are finding it difficult to get capital. When you have capital to invest in those times, all boats tend to rise with the tide. So generally speaking, the worst economic times in the U.S. economy, if you're investing in the U.S., is the best time for funds, private companies, to invest their fund money into private companies, because those economies are coming back and all boats rise with the economy.
So Tami, can you tell me a little bit, what industries are hot these days with, in light of the coronavirus and everything, completely different landscape?
Sure. I know it seems like there wouldn't be areas to invest because of the business shutdowns and because everyone's working remotely. But in fact, the coronavirus has really offered a lot of opportunities for companies that they didn't have before. So for example, I know of a manufacturing company that manages sportswear athletic wear that is now manufacturing masks. Another manufacturing company that is able to take their manufacturing lines and manufacture ventilators. There's clean tech. The clean tech industry is particularly attractive at this point. There's EnviroMaster, which is the franchise company that sanitizes rest stops and restaurants. And even though there's not a lot of travel and the restaurants are closed, they now have big contracts for sanitizing schools and government offices and supermarkets, because that's areas that are still open in some parts. There's also a robotics company that is able to go in with robots and sanitize hospital rooms without human interaction. So that helps healthcare workers. So there are still lots of opportunities in the private company space, but it's just different opportunities that did not exist before.
It sounds like predominantly it's stuff, people that kind of make stuff. You did say service with cleaning. Are there other service industries, the cleaning industry, or is that just the one that you're seeing right now?
The internet industry is booming. The delivery businesses for restaurants and for food is booming. Home delivery of groceries.
Right.
At home, checking people who are at risk, home healthcare, that industry is, of course, still booming. If we had autonomous cars, we don't yet, but if we did, that industry would be booming because people would be sending their car to go pick up groceries for them. So, there are still opportunities, and I do believe that once things start to come back, that we will see additional growth in industries that did not exist before, like the autonomous car or like the drone delivery areas.
Thank you for being our guest. And Dave, thank you for being the co-host. Guest is Joe Camarada. He is president and CEO of Quantitative Radiology Solutions. See you next time on Money Matters TV.